Alright guys, let's talk about position sizing and risk management. It's something you always have to keep in mind before you do any trades. Okay. Now in any given trade, you want to have a maximum loss of about 1 to 2% of your total portfolio. Even less. If you're starting out, I would even do less, I don't know, maybe half a percent on a position. Okay, and just to get a feeling of it. Sometimes some people risk a little more. It really depends how confident you feel in your position. All right, but you want to have this numbers in your mind. Okay, this is not set in stone, but still you want to play this game for the long run. So you don't want to risk too much in any given trade. Okay, and the risk reward is going to have to be at least 1 to 2 on trade. So for every dollar you might lose, you have a chance of profiting $2. Okay. Anything over 1 to 2 is amazing. 1 to 3, 1 to 5, it's ideal. Okay. And the position size, you want to calculate it based on your stop loss. What that means is that we have your entry position, and the further away your stop loss is, the smaller the position should be. And the closer the stop loss is, the bigger the position it could be. Okay? Because you can lose less money, right? So you can have a bigger position. So let's get an example with a $100,000 portfolio. We got in our hypothetical position, we have a short position. Okay, so our entry was right here at 227 per share on Apple. And we calculated that our stop loss was going to be right on top of this high over here. So it's going to be 238. Right. So if we entered here, we have a position of 100 shares in Apple, and our potential loss will be $1,042, which is a little bit over 1%. Okay, which goes right into this bracket right here of a whole portfolio. But our upside, if our short goes into our target, that we have already set, we would have made $35 per share, okay, which gives us about $3,500 in profit. So it's a little bit over 1 to 3 risk reward ratio, which is ideal. This is a good trade that you should take if you have this amount of risk reward. Now there's a couple ways you could enter a trade, not only by opening up a full position in an enterprise. There's always a way that you could scale into a position. Okay, this is the only way, the only time that you could add into a losing position. Okay, so what that means is that, let's say I've entered a short right down here at about 222. Okay, and every time it keeps rising up, let's say $10, I keep adding to the position. But why am I adding to a position if it's losing, Well, as you can see here, there's only 33 shares that I bought at 222. Okay, instead of 100, that was my full position on the other trade. So we actually have 3 different positions that add up to a total of 100 shares in Apple. So every $10, you can keep adding to the position, okay? It's up to you if you're going to do $10, $20. It really depends on the stock and the pricing. But all these orders would have to be limit orders that you already placed, and you already calculated the average price that your entry was going to be at if all your orders filled. Okay? And how to calculate that? Well, it's very easy. So what you're going to do is you take the entry price on each position and you multiply it by the purchased price of the share. Okay, so we got 33 shares. We bought at 222, so that multiplied gives us 7,326. We do the same with all the shares. 33 shares more at 232, and then 34 shares more at 242. And we add all that up, it gives us 23,210. And you divide it by the total amount of shares that you bought. Okay, so that gives you $232.10 average entry. Okay, which is very close to our other entry, the 227. So it's about the same amount. But this way you can protect yourself. If the stock just keeps going down, so your short stays in profit, or if it goes up, and you can keep adding to the position, but you're actually adding into a full position. You're not in already a full position when you started. Okay, so you can protect yourself this way, scaling into the position instead of opening just the full position right away. Okay, that's what you have to keep in mind. And it works the same way with the position size. So the further away your stop is, the smaller the position can be. If you got a closer stop loss, you can have a bigger position. Okay, so you always have to calculate that and be ready in case the stop loss hits. It's just part of the trading journey. It happens. You're just gonna hit your stop loss. You're gonna be okay with it because you already have your risk reward ratio, and you know how much you are prepared to lose on any given trade. And it's good. You're gonna be okay with it, okay? Because it doesn't matter. You already calculated it, and it's not gonna be a big loss or big number that's gonna impact your portfolio too much. Okay. Remember, you want to do this for the long run. You don't want to have a one big shot that you're gonna become a millionaire with one position. It's very rarely happens. So I wouldn't recommend you have that mentality. If you're gonna be into the trading and you want to keep doing this for the long run, this is the way to do it. Always have a stop loss on. Always calculate the stop loss and have it. I mean, if you're gonna calculate the stop loss, that's how you calculate your position sizing. So you already must have that in place. You don't really have it mentally. You have to have it in place because you never know when the market is gonna hit that, and you're just gonna lose more money than you need to. So let's keep that in mind and have these two strategies to enter: either scaling or into a full position.